Unit 1, the Financial System. Lecture 5, Financial Instruments and Markets, Part C. Now we're going to talk in a little bit more detail about the different market classifications for financial markets. Looking at financial markets, they can be classified as money and capital markets, spot and forward markets, derivative markets, primary and secondary markets, financial exchanges and over-the-counter markets, and interbank markets. We're first going to look at money market versus the capital market. Now, the money market is the marketplace for trading short-term debt instruments. By virtue of its name, it is for easy access to cash. Instruments have maturities of less than 1 year, and they are interest-bearing debt instruments. In some instances, the instruments are discounted instruments, so you buy them at a discount to their face value, and when they mature, you get the face value back. And other instruments are interest-bearing, so you get interest in addition to the face value. It's a very, very low-risk market, which means that the returns on these markets are very low as well. Capital markets, on the other hand, they are for trading long-term debt and equity instruments. These instruments, particularly the debt instruments, have maturities of at least a year, and they're referred to as bonds or fixed income securities. It is the market in which corporations and financial institutions and governments raise long-term funds, and these funds they use to finance capital investments and expansion projects. The capital markets are obviously more risky than money markets, but as a result of that, the returns are significantly higher. Now here we're looking at the spot market versus the forward market. Now the spot market is the market in which you trade today. So if you went out and bought a share, whatever that share was in the Johannesburg Stock Exchange today, and you expected to receive that share in a few days' time, that trade took place in the spot market. Okay? And we do spot trades in equities, in exchange rates, forex, in all sorts of markets. So you would do your trade today and you would settle in a few days. Now, the forward market, that's the market in which transactions, their terms, their prices will all be set up today, but the execution of that deal would take place at some point in the future. So if you're looking at foreign exchange, you'd look at buying a foreign exchange or buying foreign exchange in 6 months' time. Say you were expecting to import something from America in 6 months' time, you needed dollars, you could buy a forward contract in dollars. And what that means is that you could set up the terms today, so you could lock into an exchange rate today, but you would only take delivery of your dollars in 6 months' time. But this doesn't just relate to foreign exchange. Again, it relates to all kinds of assets. And the forward contract is a derivative contract. So the forward market relates to derivative contracts. As I mentioned in the previous slide, when looking at the forward market, it's actually a derivative market. It's the market where deals and transactions are contracted today, but they're implemented sometime in the future. Now, we talked about derivative instruments or derivative contracts, which are a financial instrument, and they're instruments where the value or price is derived from the value of another variable or another asset class. Okay? These variables that we're talking about can be underlying financial instruments or commodities in the cash market. When we're looking at derivatives, we have 4 basic types of derivative contracts. We have forward contracts, futures contracts, options, and swaps. Each of them have their own characteristics, and forward and futures contracts and swaps are considered to be what commitments. So once you enter into those arrangements, you have to see it out until the end. An option is a contingency claim. An option is a type of contract where you pay a premium up front if you're the buyer, and you then get to decide if you're going to exercise that contract You'll only exercise it if it's in your favor. And you can have derivatives on foreign exchange, on equities, on bonds, on other derivatives. And funnily enough, if you combine a derivatives contract with a traditional asset, so say you attached an option to a bond, a fixed income security, so that if conditions were favorable, you could convert that bond into shares, you've created a hybrid security. So now we're looking at the primary market and the secondary market. Now, the primary market is the market for the original sale or new issue of securities. Here, issuers or borrowers interact directly with the investors, and any funds or capital raised in the primary market directly affects the book value or the balance sheet of a company. So, for example, if a company decided they wanted to raise R1 billion worth of capital by issuing shares, once that transaction is completed in the primary market, the company's balance sheet or shareholders' account would increase by R1 billion, the book value of the company. When we look at the secondary market, on the other hand, this is the market in which previously issued securities are traded. So shares are bought and sold. So now, if we look at a company like Anglo American, their shares are traded in the secondary market. And the proceeds from these sales do not affect the book value of the company. They affect the market value. The company never sees the funds that are raised in the secondary market, or the funds that are exchanged in the secondary market. Those go between investors. But what it does affect, as I said, is the market value. So as the share price goes up and down, the market value of a company goes up and down. Now, if we look at the different types of secondary markets, you can have a core market, and in a core market, individual securities trade at specific times, whereas a continuous market, securities trade whenever the market is open.